All right, mic check. Mic check, mic check. Oh, please. I think I did it. I had it muted somehow. Man, that was the best introduction of all time. Can you hear me now? Gosh, I literally had the all-time best intro ever. And what I was saying was mortgage, real estate, a lot of wild stuff going on right now. I am going to be the friend who loves you and cares about you enough to give you the honest truth. I'm not always going to give you the answer you want to hear, but if you think about your circle of friends or family members who always shoot straight with you and say, listen, Linda, those are the ones that love you the most. And I love you enough to give you the honest truth, right? I find myself sometimes feeling bad when I'm honest with clients. Some clients that might not be ready to buy. And that's devastating to hear, but it's the truth, right? Or other clients who, are a little bit too optimistic about their finances or their plan or something. And I just give it to them straight. It might not be what you want to hear, but it's the honest truth. So anyhow, that's what I'm going to be for you guys. So let's jump into it. Now that we actually have working sound, I don't want to mess with anything too much. I think it was just a button I pressed. Mortgage guy, yes. Tech genius, no. If you guys have not heard, the 10-year treasury was up to something like 2.14 last I checked. Also, mortgage rates have not had a great day, but it doesn't mean it's not a great day to buy a house. Let's show this just so people can see, just because it's fun sometimes to look at a graph, a chart. Share screen. Just to give you guys some perspective. This is what I'm looking at today. 73 basis points worse. The 10-year treasury is up to 2.14. I looked at this chart. Let me see if I could show it bigger. This one over here on the 10-year treasury, it was only like 2 weeks ago when this was like 170. What date is it right here? March 7th. Holy moly. That was last Monday. Last Monday, we were in the mid 170s. Got as low as 1.7. And 2.14 in a week. The 10-year treasury went from 170 to 2.14 in a week. I mean, no wonder last Wednesday we lost like 100 basis points in pricing. This Monday, you can see there we lost 73. Down is bad for mortgage rates, FYI. So mortgage rates that were up here 10 days ago, 1.285, are down to 101-ish. It's 180 basis points. That'll change what your 30-year fix looks like. You want to see? You want to bring this bad boy over? I remember like this little dip we saw because that was last week. No, that was the 4th. That was 10 days ago. That was the Friday before last. And I was telling people like, this is a momentary thing. Like take advantage if you can, because then, but bam, today's average says 4.41% on a 30-year with 0.4 points cost. I mean, that's bananas. Not bananas as in 4.4 is a bad rate, but bananas in how fast we can go from 2.7 back here in early August. It's only 7 months ago. 7 months to go from, let's call it 275 to pert near 4.5, a 1.75% change in 7 months. The part about it that's maybe scary for people who are in the market to buy right now is we ain't done yet. And this isn't something that you should expect to calm down. Tomorrow, March 15th, and the day after, March 16th, is the Fed meeting that we've been waiting for. Is Jerome Powell going to raise it 25 basis points? Is he going to raise it 50 basis points? What is he going to say when he does a live Q&A on Wednesday about Fed policy moving forward? The Fed and all their actions with monetary policy is going to push rates higher in the next 6 months. I'm not Men's Warehouse, but if I was going to guarantee something, I would say you could almost rest assured Q2, Q3, you're going to see higher interest rates. I don't know what today's big jump was all about. Was it that we feel like there's going to be more peace talks between Russia and Ukraine? Because I can tell you when that stuff gets resolved, and we all hope it does, we all want peace on earth, I hope, rates are going to go higher. Any geopolitical economic uncertainty is good for interest rates. We've got so much upward pressure on interest rates that even that isn't stopping us right now. So when we take that lid off, 4.75, here we go. Anyhow, I don't want to pump FUD into because 4.5 is still a great rate on a 30-year fixed. Home ownership is still, something that I think a lot of people prefer and would be advised to do above constantly increasing rent prices. The truth of the matter is everything's getting more expensive. Rents are getting more expensive. Homes are getting more expensive. The cost to borrow, the interest rate is getting more expensive. It's all getting more expensive. You just got to choose which more expensive do you want. Do you want the more expensive home ownership that also includes debt pay down, which also includes appreciation, which has been proven to increase your wealth over time? Average net worth of a homeowner versus the average net worth of a renter is something like 40x. Not double, not triple, not quadruple. 40x. That's mucho for the Spanish speakers. Anyhow, my rant of the day. I got a lot of stuff that I want to talk about. Different things I'm seeing, different things I'm hearing. I'm going to make some future videos about, people looking to upsize, what things they should take into consideration. I'm going to make a video on, payment shock, sticker shock. People that don't understand when you buy a more expensive house, you also get a bigger property tax bill. You also get more expensive homeowners insurance. Do not, and I repeat, do not rely on an online calculator to give you a monthly mortgage payment. It's just too nuanced. And, you have to be working with professionals that can tell you, oh yeah, in that neighborhood, there's Melrose. Oh, in this neighborhood, you can expect to pay triple for homeowners insurance because it's a fire area. Whatever those things are, right? I've got clients that are like, oh my gosh, I didn't realize if I bought there for $700,000 with 5% down, I'm going to have a $4,000 a month payment. It's because you got Melrose tax tacked onto that, regular rate for property tax, where your taxes are $1,000 a month on a $700,000 house, which isn't the norm for California. But for that neighborhood, that's what you're going to pay. So anyhow, let's jump into some preguntas, some questions. Sorry again about the mic issues, man. That's not going to make for a very good replay. Joey, my man, good to see you back as always. Loyal follower of the show. OKC, good to see you. Oh, that's a great question. Talk taxes for real estate investors. The best place to find a great referral is by people doing the same things you're doing. If you want a great tax person for real estate investors, talk to some real estate investors, and I guarantee you, if they've got a great person, they're going to want to tell you. If they don't, they'll tell you that as well. It's super important because like a real estate agent who's great at getting people into their primary residence and is a great agent, great at communicating, great at doing agent things, might not be a great agent for real estate investors. And the same thing goes for a CPA. Might be a great CPA for certain types of clients, but just doesn't work with enough investors to know some of the nuance with that. Back to my thing about the mortgage calculators online. You're really seeing that, Tesla mister? The mortgage calculators have 1 or 2%. I mean, the worst is when they don't factor in tax and insurance, or they'll have this interest rate that's super low, or where a lot of people get tripped up is their default thing is 20, 25, 30% down. First time buyers aren't putting $300,000 down. They're putting down 3%, 5%, maybe 10%. But once you really dial in the calculator and you see, holy moly, $4,000 a month, it's going to make you reconsider, as it should, what price point you want to buy in. Your first house, you shouldn't feel strain because of the mortgage payment. I just personally don't believe that that's what you should do. Your first house should be entry level, very affordable. And I think that most people I talk to that are doing it right are looking at that first house and saying, this might be a future investment. Let me look at it at least from an analytical perspective, from an investor's viewpoint. If I moved out of here in 3 years, it would probably rent for this. I know my mortgage payment is this. Would that pencil? If it does, great. You save a down payment, buy a new primary 5 years later with 5% down, hold on to this place, let the renters pay it off over the next 27, 25 years that you have left on the mortgage, and have a paid off asset that's worth $1 million in 30 years and let it pay you. Sounds like a pretty good plan to me. I've got a really cool story for you on people having second thoughts or backing out of buying a home. I might be remembering incorrectly. I just talked to too many people and listened to too many podcasts to remember. But if I remember correctly, it was Omar, real estate agent, who is a guest on my buddy Mike Zuber, One Rental at a Time channel. He was talking about where he does business, Southern California, high desert area. He saw a lot of people backing out of contract. And what it was, when he started to dig a little bit deeper and he started to try to figure it out, like, why are people backing out? Are they getting cold feet? Is it that they can't afford it because the interest rate's gone up and the payment's gone up $200 and they no longer qualify? Like, genuinely didn't know what it was. Dug in a little bit. Here's what it was. Super interesting. Super competitive market. I can relate. Hundreds of pre-approved buyers who are shopping every single week. In a market this competitive where it's really hard to get an offer accepted, you know what buyers are doing? You know what agents are doing? Let's submit on that one, $550. Ooh, this one came up. I think we can offer $530, maybe get accepted. Offer there. Oh, you know what? This one I really like. Talk to the agent. Okay, $545 might work. Submit an offer there. 3 offers, 4 offers at once. I'm not saying whether it's right or wrong, whether I condone it, whether I would do it. I'm just saying it's happening. And as you would imagine, every once in a while, you're going to get accepted offer. Then the client is going to have to say, well, I like that one at $560, but that one at $530, same size house, neighborhood might even be better value. I'll go with that one. Let's back out of the other one. So they back out of that one. Maybe that person was selling that and buying something forward, right? And it forces them to back out. Some of that stuff is going on. And when I heard that explanation, one, very interesting. Two, doesn't surprise me. I know agents are doing it. It's a tough market. Anything they can do in their power to get a buyer's offer accepted, even if that means submitting multiples, they're doing it. I would love to hear from agents because I don't even know if, that's against any specific rules, if that's frowned upon. I think it is. Maybe I'm gonna ask some agents. Frown multiple. And as people who are submitting offers, you guys let me know. Are you putting in multiple offers at once? I think it's good topic for conversation, if nothing else, right? What is, what it's like on the buy side, because we all know competitive AF, tough AF. I've got a real estate agent who I talked with earlier who told me they were going to list 6 months ago for mid 600s. And the client felt like that was a stretch. Now the agent went out there and said, listen, like it's going to be 700 plus. We're going to list that. I promise you, I see comps. We'll list it at 709 and see what happens. Client's ecstatic, right? On the sell side, thinking that you were happy with selling for 640 6 months ago. Now knowing that you can list for 709 and the agent's like confident, makes you feel good as a seller. They list it, it goes bonkers. They're going to sell it for over 800, something that they would have been happy to sell for 650 6 months ago, which for me is very interesting because of that mortgage chart I just saw you. I just showed you. English is a tough language. We went from 2.6, 2.7 to 4.3, 4.4, and people are still willing to pay 15% above the list price. Wild, wild times. All right. I can't find any questions. You guys keep them coming. I love the questions. In the meantime, let me share something with you because I think this is kind of cool. I'm going to share it in some future mortgage videos. I don't hardly ever, I never have promoted any company or tool or anything or done any sort of affiliate stuff in the past. I've got a channel that's providing mortgage education. I'm here to help folks. I'm here to guide financial education, literacy, empower you through education to make smarter financial decisions about real estate, specifically your mortgage in a lot of scenarios. But for the first time ever, I've got something that I think is valuable. I'm going to post the link in the chat. I talked to the folks over at Kickoff, and what they do at Kickoff is they essentially have a credit builder tool. You go and check out that website, do whatever due diligence you want. It's $2 a month for this credit tool. What it does, you got this credit builder account. You've got a $500 line of credit. Most people don't use that line of credit. The only place that you could use it is in this Kickoff credit store where it's like financial literacy stuff, right? But let's say you don't use it, which I don't really think the purpose of it is to go out there and spend $300, $400 on financial literacy products. It reports positive credit payments every month. You pay $2 per month. And your debt utilization, which is credit limit versus how much you owe, shows up month after month, under 10%, right? You've got a $2 balance or a $24 balance for the year showing up with a $500 credit limit, and you're making payments every month. If you're 18 and just establishing your credit, if you're older and had some credit challenges and you're reestablishing your credit, this debt utilization piece is like 35% of your credit score. It's huge. And talking to the folks at Kickoff, what I told them is somebody who just genuinely wants to help people out. If you can increase somebody's credit score by 30 or 40 points, that can affect the rate they get on their mortgage by a quarter point. If they're borrowing $400,000 and the rate's a quarter better, they're saving $100 a month for the life of that mortgage. That's a lot. That's a pretty good return for a $2 a month payment. And once you get the mortgage, cancel this friggin' thing if you want, right? But if you're establishing credit or reestablishing credit, I think it's valuable. I think that it could be, something that a lot of people would see a lot of value for. So where did it go? I put it in the comments. It's right here, kickoff.pdf.io/MTMG. If you use that link, I get some credit. They give me a couple bucks. More than a couple bucks, I promise you, I don't need it. I'd love to see people signing up for it, getting value from it, increasing their credit scores. Because like it or not, credit plays a huge part. The rate you get on your credit cards, the rate you get on your car loan, the rate you get on your mortgage. The example I showed where you're saving $100 a month on your mortgage, I see some people that need to get into a, mortgage when they've got a 630 credit score. And the difference between that and a 760 is humongous. Might be a full percentage point. And if you're putting down a small payment, you might pay double in mortgage insurance. It might be affecting you by $5,000 a year on your mortgage. Your credit card, 10% versus 17% is going to be, a big chunk of change every month in added interest. So check it out. If it's great, great. If it's not for you, no big deal. It's not for everybody, right? But I think the two folks that are going to benefit the most, younger, just getting started, or reestablishing credit after some sort of derogatory event where you're like, hey, listen, I filed bankruptcy, I'm reestablishing, and I need to have credit lines with low debt utilization and the positive payment history. Those are the two things that it works, right? Why do they give people with low credit score a lower rate like FHA? FHA generally has lower rates. Does not mean it's a better loan product. FHA is a government-backed loan. And so you can have a lower interest rate, and FHA is able to write that loan and feel good about it because they're collecting monthly mortgage insurance and it's federally backed, right? So you put side by side 3.5% down FHA with 5% conventional. If you've got a 760 credit score, you're going to go conventional all day. FHA, you can still get really good terms with a worse credit score because it's federally backed. That's the real answer to your question. Hey, Jeanette, thanks for joining. Appreciate the question. And this is a great one. And this is another great time for a great plug. Financial Literacy Week with U Mortgage. God, I got to get a link to that. We're doing that 2 weeks from today, March 28th. It's going to be all week long. I'm doing the refinance section. I'm going to talk about refinance. I'm going to answer questions just like Jeanette's got here, all about refinance, when it makes sense, when it doesn't, what questions you should be asking, the do's, the don'ts, the beware, all about refinance. All have information about Financial Literacy Week for sure. Next week on my live, it's free to everybody. Come join. It's literally a week long talking about all things financial literacy. My buddy Jimmy's talking about investment properties. I'm talking about refinance. Other people will be talking about investing. Super cool thing. It's an initiative by U Mortgage. We're aligned in that, educating the consumer is something that we're all passionate about. Financial literacy is something that you just don't get enough of in schools. You just don't, right? So we're going to bring it to the people in masses. Let me see if I can find U Mortgage Financial Literacy Week. Okay. All right, I'm going to give you guys a link. You know what? Better yet, let me try to multitask. Financial Literacy Week. Literacy Week. Copy. There we go. I found it. Go there. Sign up. It's free. Anybody you know, anywhere, any age, any credit score, any job, anything. Financial literacy is helpful for everybody who's playing this game. So check out that link in the description. I'm going to get to your question, Jeanette, I promise, about refinance. Just real quick plug for Financial Literacy Week right there. That's the link. The link will be in the comments. I'll put the link in the description. All the stuff, all the links. Okay. The first question I'm going to ask you, Jeanette, is how much do you owe? If you owe $110,000, I can almost assure you going from 5.25 to 4.3 won't make sense. You'll save $956 a month. I'm sorry, a year. $1,000 a year, give or take, in interest. And I did that quick math because 5.25 to 4.3 is about 1%. And 1% ish on 100 grand is about $1,000. So let's call it $1,000 a year in savings. We write loans with very low cost structure, no underwriting, no processing, but still, you know, for the 4.3, depending on credit, there might be, you know, a small amount of lender fees in box A, no matter where you go, partly because lenders aren't going to be super sharp in pricing on the smaller loan amounts. And then you've got title fees. You've got other baked in fees where if you're going to pay $3,000 or $4,000 in fees to save $950 a year, I just don't know if it's worth it. But if you owe $400,000, $500,000, it makes sense to go down 1%, right? You go down 1% on a $500,000 loan, you save $5,000 a year, and there's less than $5,000 in fees. Your break even's 1 year. That's something I'm going to go over in that Financial Literacy Week. It's something that I believe in because I probably did thousands over the last 24 months. Because that's all it was for me. I wasn't selling. It wasn't a sales thing over the last 2 years with refinance. It was a cost versus benefit analysis, a break-even analysis, whether it made sense or not. The crazy part is there was ones where I literally tagged them green light refi. And I told my team, these folks might not know it. They should be refinancing. We don't want to sell them, but we want to kindly push them. This makes sense for you in your financial picture to refinance. If you're going to stay in this house for at least the next 2 years, please do it for you. If, you know, sure, we make a commission, but really there was like some people it really made a lot of sense. So that's that break-even analysis. The more you owe, the more benefit there is from a lower interest rate, because you're paying more interest with a bigger balance. Holy moly. Great question from Mary Salome. Thank you for joining, Mary. Bought your rate down to 2.875. Kudos. July of 2021. Great interest rate. You know, great that you're able to get into a house. You haven't had to deal with all the madness. Paying $45 for PMI. I wonder why you put down 17%. Was it just a cash to close thing? Because you're so close. You were so close. The other 3%. Just curious, I guess. So you want to remove the PMI. You say, hey, I got 20% equity now. You're going to have to contact your servicer. Whoever's collecting payments on this loan, servicing the loan, is going to be the one you're going to want to check with. All lenders are different, and a lot of them have a 24-month rule where you can't apply to have that removed until you've hit 24 months. You might have to pay them until July of 2023 before you can ask to have that $45 removed. The good news is it's only $45. But for sure, you're never going to refinance to get that removed because one, rates are higher, and two, the cost of the refinance for that little $45 doesn't make sense. So whenever you can, whatever their process is, a lot of them are going to either do a drive-by appraisal or some sort of appraisal to be able to look at it and say, okay, you owe this amount. It's worth this amount. We can remove the PMI. So best of luck to you. Let me know how that goes. I got a few clients who are working with their servicer to get mortgage insurance removed. And I've just heard different stories from different lenders. It's different in different places. Kim L. Another good question. You guys got the best questions. I mean, kudos to people in the comment section. These are the type of questions where hopefully I'm adding value to you by answering the question for you, but this is just stuff that other people are curious about too. I can guarantee it. Guarantee other people are curious about this stuff. So you're putting down 10% and you're looking at it and saying, if I do another 10,000, it's going to lower my payment by $50 or $60. I think it's probably closer to $40 or $45, truth be told, because some of the costs of your payment are fixed. Taxes are going to be the same. Homeowners insurance is going to be the same. The 10% down, if you owe 170, let me see. I'm going to do an example, right? Where you're buying for 600, you're putting 10% down. And I guess maybe it's 50 or 60 now that rates have gone up. Maybe it was 45. I'm thinking of when rates are lower. But let's see. If you borrowed 540 and your rate's 4.25, you've got 2656 as a principal and interest payment. Now, if you put 10,000 more down to get your amount owed down to 530, I know my answer, but I'm going to do the math first and then I'm going to answer it just because 2607. Yeah, $49 at 4.25. It's going to change based on rates and whatnot, loan size and all that, but let's call it $50 for this argument. This is a very client specific question, as is a lot of mortgage stuff. And I think it's personal. There's some people that an extra $20,000 to save $100 a month, very important. On a fixed income, you want that payment that's $2,000 a month. And if you didn't pay that extra 20, it's going to be $2,100 a month. And it's going to feel tight every month, right? So you've got the money now. Maybe you sold another property. Maybe you've had it, stacked up in savings waiting to buy. In that scenario, maybe it makes sense. I personally feel that $20,000 in an emergency fund, when you're able to borrow the money at 4%, I wouldn't plug it in and have it essentially locked away in your home's equity because it doesn't give you a lot of options. By having that $20,000 sitting in the bank, or like you said, invested somewhere, you've essentially got that extra $100 of your payment stocked away times 200 times, right? By having 20,000 in the bank. So if it's tight every month and you've got to take 100 a month from that account, fine. You do that, right? Truth be told, you're not going to be in that mortgage for more than 3 to 5 years. So you're not going to need 200 months worth of it. But I think invested somewhere, or a lot of families, mine included, find some security in having that emergency fund, having that money sitting in an account where if something happens with your job, your spouse's job, unforeseen expense comes up, there's no healthcare stuff that could come up that you'd have to pay for. Having that, is valuable, more valuable than $100 a month in savings. And most people I talk to, if 2,000 versus 2,100 is a make or break on your mortgage, you probably shouldn't be getting into the $2,000 mortgage either, right? If it's that tight. So anyhow, that's my 2 cents. Hopefully that helped. I think it's an individual question that has to be asked, and only but I personally think that I don't plug extra money into that unless it's a specific situation where someone's on a fixed income. Oh, Mary. It would have been slightly higher, but it still would have been worth it to not pay $45 a month. There is a slightly better rate at that 17% down only, and slightly better means, you got 2.875 for 2,500 points, but maybe if you put 20% down and you paid 2,800 in points, you could get the 2.875. It might have been a few $100 difference. I don't think that was good advice, though, truth be told, because now you've got this $45. It's probably on there for at least 2 years. Oh, mortgage folks, please do not give people bad advice. The end. All right, K9 Quiche. If you like dogs and your name is Keisha, it's my best guess. Cash out refinance for renovations, new roof, and credit card debt. A lot of people are in your position, so this is a great question. And I think that if you do it responsibly, if you do renovations, if you pay for the roof, if you pay off credit card debt, your rate is going to go up unless you pay a bunch of points to lower the rate. So you got to be prepared for that. 100K left, depending on what it's worth, maybe you do a cash out and your new balance is 160, 180, and you're 4.25, 4.375. Just make sure that's a comfortable payment for you and that you're not overextending yourself. I think there's a lot of folks who, when there's a lot of equity available like there is now, can get themselves into trouble by going from a $1,300 payment to an $1,800 payment. And I think the thought process sometimes might be, oh, well, I'm knocking off this credit card debt. I pay $450 a month on that. So it's like I'm paying the same with the two combined, and I got to get the new roof. I'm gonna do the renovations. So I'm all good. They continue the same lifestyle that got them to rack up the credit card debt. And so a year from now, they've got another $26,000 in credit card debt. So now they've got an $1,800 fixed mortgage payment and paying $400 or $500 a month to pay off this newfound credit card debt. And that can cause issues. So I think just be responsible with it. Certainly investing in a new roof, renovating your home, and paying off bad debt are all good things. These are all good reasons. Make sure none of that money goes towards Vegas trip or, other things that are a bad use of money, right? That's where people get in trouble when you pull cash out and you buy a boat or buy a Hummer and, add more expense to your life without any real value. But the renovation's good, roof good, paying off bad debt good. So I think you're on the right track. Matt Bittner hoping for 50 basis point hike from Jerome Powell. I think I talked about that in the beginning when I was muted, right? Like all the things going on. We've got the Fed talking. Their meeting is going to be tomorrow, the 15th, and Wednesday, the 16th. On the 16th, they're going to open it up for questions. When the press asks Jerome Powell questions, I think that this is always a really volatile time in mortgage because based on what he says and how he says it and what people perceive is going to be future actions by the Fed, it's going to have an effect on interest rates. Did he do 25 basis points? Did he do 50? Did he talk about what he's going to do with the trillions of mortgage-backed securities on the balance sheet at the Fed? Is he going to be, super quick and running that stuff off the balance sheet? Is he going to do 50 basis points now, 50 basis points in the next one, and just comes out and says, listen, I'm fighting inflation with a machine gun. I'm going to go out there and squash inflation. I'm going to act swiftly and with vigor, and I'm going to go out there and fight hard. I don't think he'll say those things, but I don't know. Seems natural. All that stuff is going to have an effect on what interest rates do over this week and the coming weeks. The 25 or 50 basis points, whatever their action is for the Fed funds rate, which they're going to increase the Fed funds rate by at least 25 basis points. Maybe 50. I don't know. I feel like he's kind of backtracked on that, and so it's not as likely as it once was. We kind of all expect that. What we don't know is what he's going to say on Wednesday. So it'll be interesting. It'll be interesting to see. All right. Vakul Moore. This is a great question. And I'll be super transparent and honest about my personal journey with this, because I feel like as I've become more seasoned, talked to more people in the investing space, I've probably changed my stance on this. Part of it is the lower interest rates. If you've got 2.5, 2.75, 3.125, anything really sub 4%, paying aggressively towards your mortgage isn't the best course of action for a lot of folks. And I say a lot of folks because not everybody. I've got a great real estate agent partner who I love and respect and talk to on a regular basis, who's a big Ramsey fan. I just can't get behind it, but there's a lot of people who get a lot of security and they feel really good about paying off all debt. So they would tell you, pay as much as you can, pay it off as soon as you can, all debt, pay it off, foot on the gas, no matter what the interest rate. Maybe it's the, where I'm at in life, or maybe it's less risk averse. I don't know what it is, but I would rather take money and invest it in appreciating assets than pay down a mortgage that's sub 3%, if that makes sense. So I think at the end of the day, my advice is it's personal preference. Do you want to, the thing about paying off your mortgage, let's say it's a 3.25%, you got a guaranteed return, right, of 3.25. If you're paralyzed and don't want to invest, and you've just got money burning a hole in your pocket or sitting in your savings account, then maybe you do that. The money being so cheap, I would say make sure that you've got money sitting in your savings account before you lock it away into your home equity. Because you pay it in, sure, you can get it out with a home equity line of credit or a cash out refinance, but it's not easily accessible. It's not super fluid. So tell me what I said that was contradicting. I personally say no. Others say yes. I think investing somewhere else is my answer and what I would do, especially because your rate's only 3%. You could go buy a bad real estate deal and get 6, 8, 10% cash on cash returns, have someone else pay the mortgage while the thing appreciates, and the debt is being paid off, versus plugging all your extra cash to pay down a 3% interest rate. I'm not a big fan of it. So hopefully that was more clear. But with all that being said, that doesn't work for everybody. Some people like the feel good, the certainty of owing less on the house. I mean, if you look across mortgages, there's like the average homeowner has 50% equity or some wild number, right? Like people aren't all trying to leverage and use cash and go out and do other stuff. People are doing the pay down stuff. Hopefully that was helpful. All business. All right, K9 Quiche. Thumbs up. You get my approval. No funny stuff, okay? No Vegas trips, no Wagyu steak, no spinning rims. I made a comment about spinning rims because great YouTuber, what's her name out in Georgia? She was talking about a lot of people who are buying cars before houses. Not the jam. Not the jam. That's all part of Financial Literacy Week. Trying to, game people up where if you want a good financial future, if you want legacy wealth, if you want to do stuff that's going to feel good for the long term, don't go out and buy depreciating assets like cars. Especially don't do it before you've ever bought a house. One, you make it harder on yourself because your debt to income ratio changes with that car payment. And two, you're not building equity like you are in a home with a new Cadillac Escalade with spinning rims. All right. All right. Tesla. I currently don't have a steady income. My sister agreed to co-sign for me. Are there extra fees on the loan when someone co-signs? No. The lender loves to have more than one person responsible because you guys will both be responsible for that payment to them. They're just going to take the two borrowers, you and your sister. The lower of the two credit scores is what you're going to qualify on. And, as long as she's got the income to help you qualify, it's only going to be helpful. But just know that if you're on there with a 675 credit score and she's got an 802, they're going to use the 675 as the credit score when it comes to like rate you're qualifying for. Kyle in PA. Another 10 out of 10 on the question scale. You guys came with it today, and I appreciate each and every one of you for coming with the good questions. Do you think mortgage rates can rise to 5% at the same time home prices are rising? Won't it become unaffordable eventually? I agree 1,000%. I have a team meeting every Monday and Friday. I've got awesome, intelligent staff. We're all watching real estate. We're all processing 60, 80, 100 applications per month. We see a lot of stuff. We talk to a lot of buyers. We talk to a lot of real estate agents. What we're seeing right now, rates increasing as fast as they are, somebody who qualified for 680 reanalyze their situation. Now your max is 650. With the recent shift where rates might have gone up a quarter in the last 7 to 10 days, we might tell them they're only qualified up to 620. And so, for people like that, they're still going to qualify. They're going to qualify for less. And if the houses they were looking at that were 600 and in their price range, when they were qualified up to 680 at the lower rates, right? If the house is now 650 and based on rates, they only qualify for 620 now, they're SOL. What I'm seeing and what I would imagine happening to a lot of folks is you're going to have to look in different neighborhoods. You're going to have to look at less fancy houses, maybe one bedroom less, or like some people are doing, they're putting off home buying for now. But I definitely think there's got to be an inflection point, Kyle. Like to say there's never an inflection point would be ignorant on my behalf, like, oh no, people, there's so much demand, nothing would ever stop it. Well, of course, if interest rates went up to 8% and home prices went up another 50%, it would crush demand. I'm not an idiot. And I think the most recent events and what's gone on with home price appreciation and rates, the biggest problem is the speed in which it changed. If we looked at home prices a year ago and saw a bunch of markets that saw 20% appreciation, and we also add that rates are 1.5 points higher, that has absolutely killed the what people are able to buy. Sorry, I paused for a second. Somebody came in the office, but nobody's home here. Hold on one second. Pretty good for you? Yeah. Are you mad at the mortgage guy? Yeah. Okay, here you go. Sign up for your numbers up right now. Okay, yeah, thanks, brother. All right, that was a test to see how many people would stay. I appreciate you guys. Fidelity National Title sent me a doc package or something. Not sure why. God, they should have probably sent that to corporate. Anyhow, that's another story. So the answer to your question, Kyle, to wrap up, man, I'm in a weird mood. Sorry for bouncing out on everybody. Is it's going to put a strain on affordability. I think it already has for a lot of folks. We've seen wage increases, and a lot of people probably poo-poo that, like nowhere near the 20% home price appreciation. I agree, right? But we're gonna see. We're gonna see what happens. I thought that we'd see more strain on demand, more strain on affordability with the 2.7 to 3.7, that 1% uptick in rates. I genuinely haven't seen as much pullback on demand as I thought I would see. Still a lot of well-qualified buyers who are willing and able. And those are the two things that we want to watch, willing and able. Right now, there's some people that are able to buy. They go out there and they look at something for 700 that gets bid up to 825, and they're able to, but they're not willing. Like, no, I'm not going to pay 825. And so that's going to be something to watch, along with people's diminishing ability to buy. Right? The able is going to start to come off the table for a lot of people. People that were qualified for 650. If interest rates go up and their max purchase price goes to 580 and home prices continue to increase out of that zone where they're pre-approved, it's going to be tough. It's probably going to have a stabilizing effect on the real estate market. And when I see stabilizing, it's like 15% appreciation, 20% appreciation, like all this appreciation that keeps going up. Nobody wants it to go up 20%. I shouldn't say nobody. Most people don't. I certainly don't. If we went flat and saw 0% home price appreciation, I would be happy. Other real estate investors I know that own a lot of real estate would also be happy. They don't need another, 600 grand in net worth gains by just holding on to real estate. I personally have hundreds of people pre-approved that I want it to be easier for them. It might not be cheaper. It might just become flat to where prices don't increase. But if there's 3, 4, 5 offers versus 15, that's easier. And that's what we're hoping for and looking for. Ooh, Leroy, this is what we want to hear. At a very large home builder, it seems as though sales are slowing down. What do you see in retail? In retail, I don't see it yet, and I think it's a function of not any inventory. In a place like Sacramento, where we've got 15 days worth of inventory, even if demand comes down a little bit, there's such little supply that $700,000 house is being bid up to 825. So I think we have a little bit more runway before we feel the pain. In your world, Leroy, where it's a large home builder, maybe you guys see it first because there's probably more inventory there's been in a long time as far as new build stuff goes. So, and most home builders in areas of California that I'm paying attention to, they're building stuff at higher price points because it doesn't make sense to build entry-level homes. Like, you got to build somewhat luxury. And that stuff might slow down first, right? There's still so much demand for the entry-level stuff that might take a while for that to slow down. So that's my guess. Thanks for letting us know about that. That's interesting to hear. I almost said it. Caesar, when you said, like, I agree with the car thing, except for right now. Like, I'm saying that, and people who bought cars recently are like, oh no, my used car is worth $5,000 more than I bought it for. That's not how it works, like, ever. So don't expect cars to appreciate. They don't over time. When there's a shortage of chips, like there is now, home price or car prices have gone up. It doesn't happen. All right, VK, another popular question. I appreciate you joining. Best of luck to you as a first-time buyer currently in the market. It's not easy, but I promise you it's worth it. There's no true lock and shop products that are really worth a damn. So it's a complicated no, but just know that if somebody's going to offer you a lock and shop, lock now, buy later, it's going to be a 5% interest rate. And you're going to find something that you're able to lock in for 30 days or 45 days. If you're going to find something in the next 30 days, rates won't be that high. So don't pay a premium and don't take a very high interest rate for some lock and shop. It's more of a marketing ploy than anything else from everything I've seen. If you guys find something different, then prove me wrong. All right. Jonas, selling my house and upgrading. The proceeds will pay off my vehicle loan and my wife's credit card and her vehicle too. That eats up about 60% of the proceeds. And the rest, I'm guessing, is going towards the down payment on the new place. Oh no, there we go. Remainder of the proceeds will just hold cash, go into Bitcoin, gold, and silver. I don't want to give any investing advice. I just want to remind people to be careful, invest responsibly. Got 10K over ask and a $100 gas card. Oh, that's pretty funny. I wonder if agents would just write that into the offer just to be funny, like a gas card. Buy your gas for a month. All right, Joey. Asking me this question, but I think it's a good one for any real estate investor. Bookkeeping software to track your numbers. I've got half of my stuff managed, and then probably 2/3 of my stuff managed, and then a third of it that my wife and I just self-manage. The self-managed stuff, I literally just use Excel, and then the stuff that's managed, they're doing all the bookkeeping. I'm just having them send me the end of year reporting to give to my CPA. Stessa sounds cool. I'll have to check it out. But I'm no expert there, so I'm probably no help. You're probably, more knowledgeable than I am about bookkeeping software and apps. I'm trying to think of if when I was running my mortgage business through an S corp. I was just using QuickBooks, but I don't think we had the property LLC integrated into QuickBooks. It was just for the mortgage business. So anyhow, I'll check that out. Matt Bittner. I'd love to just give my opinion on this, and I'm not an expert. I got investor buddies that are in the weeds and in the trenches looking at this stuff. There's not going to be a lot of foreclosures in a rapidly appreciating market. People have too many options. And as you can imagine, no matter how irresponsible you are, no matter how dire someone's personal position might be, if you owe $300,000 on a house that's worth $500,000, you've got options. I think the people that are really winning on the investment side are getting to these people before they foreclose. Getting to them and saying, hey, listen, this house is worth $500,000. I know you haven't paid your payment in 9 months. I'll get you current. I'll give you $15,000 to repair the house rather than foreclose and walk with nothing. Once I do that and that, let's split the profit. They'll profit $160 in each pocket, $80. For the investor, $80,000 in profit. Sweet. For the homeowner, $80,000 where they were going to walk away and get nothing. Sweet too. Everybody wins. And so I think I'd expect more of that because of how much appreciation we've seen. If the house was worth $320,000 and they owed $300,000, not enough meat on the bone to entice an investor to help. The borrower doesn't have enough incentive to try to make something work, so they just walk away. Vast majority of the foreclosures that happened back in the crash, people were upside down. There was no incentive to try to do anything but foreclose. So without any huge home price reductions, I don't think we're going to see a lot of foreclosures. I just don't. So even though there was this moratorium where you couldn't foreclose, and like a lot of people were like, well, they're going to open up the floodgates and here we go. Not seeing it. I don't think we will. All right. Eyes are starting to close. We did a good 67 minutes. I know the first 3 minutes I was muted. Apologize for that. All right. Free tools. I like that. All right. Last question I'm going to get at is from JJ. Common question. Is this market bad for a first-time home buyer? I wouldn't call it bad, JJ. I would call it hard. And I'm not trying to sugarcoat any of it. That's not my style. I'm going to keep it real. It's hard for first-time home buyers. It's a market where you're going to have to pay a premium. You're going to have to offer above the list price in almost every market that I'm tracking. You're going to have to, either waive certain contingencies or shorten them considerably. You're going to have to close quick. You're going to have to compete with multiple offers. It's going to be tough. The better question to ask is, are you financially prepared to buy your first home? That's the yes or no that you want to get to the root of. I've got a good job. I've saved a down payment. I've got some emergency funds. I'm ready to buy. And don't buy the max that you can afford or the max that you qualify for. Buy something well within your means. Don't make it a stressful thing, right? If you own a home with a $1,700 a month mortgage and you're used to paying $1,700 or $1,800 a month in rent, you're going to be just fine. You've got a fixed payment that's not going up over time. You don't have a landlord telling you you can't paint your house. You don't have a landlord telling you we're going to increase your rent to $1,850 next year and $2,000 the year after that. You're going to be in a fixed rate 30-year mortgage, which is a pretty sweet thing to have. You're going to build up equity over time as it appreciates, as you pay down the mortgage. That's the kind of stuff that you should be thinking about. And I don't think it's ever a timing thing. When I bought in 2006, I was a first-time home buyer in 2006. People might have said it's a bad time, Matt. Home prices are inflated. To pay $345 for this little 1,532 square foot house, expensive. Don't do it. And you know what happened? I bought it. I bought it on bad terms. I bought it on a 6.75 adjustable rate first, a 12% second. I put zero down. Between my first and my second mortgage, it was $2,800 a month. Me and my now wife, who was my girlfriend at the time, each had a friend renting a room. We couldn't afford that by ourselves, so we had to have people helping us. Had our first child in 2009. My wife had some complications with the pregnancy, spent over 60 days in the hospital. All around the time where things were foreclosing around us for $180,000 after we paid $345. Lucky for us, we're able to hold on to that home. We're moved out of it, but we have renters in there that are great renters that pay the rent on time every month. They pay us more per month in rent than we pay to the mortgage company. It's worth probably $550, and it's going to continue to be a great investment because it's a long-term hold, right? In 2009, it didn't look good. In 2011, it didn't look good. Shoot, in 2015, you could have made an argument that it was a bad investment. In 2022, I'm sure that it's going to be paid off in the next, I don't know, we've refinanced a few times, 10 or 15 years, we'll call it. And it'll be worth $800,000. And after tax and insurance are paid and the rent by then is $2,800 a month, it's going to be a $2,000 a month retirement plan for me and the wife. All because I held. All because real estate appreciates over time. When you own a property and somebody else is paying the mortgage, it's being paid off by somebody other than you. So I don't know. A very long diatribe. Is diatribe a word? I'll look it up. Sometimes you got stuff so deep in there, you're like, I don't even know where that came from. It's a great market for buyers who are ready to buy. It's a terrible market for buyers who aren't in a position to buy. That's my final answer, JJ. Thanks for watching. I appreciate you guys. Until next time, we gonna see.